Hi guys, how are you all doing? It's a pleasure to be with you this week. Well, let's put up our charts and see what we got. All right, what I want to have a look at, just want to show you the setups on the daily time frame, then we'll quickly drill down to where I am seeing some opportunities for us to be looking at. So I'm just shifting all my charts to daily here. Okay, so just starting off with the Nikkei 225. Now, what's interesting about what we got here, I mean, you can see today is already moved. Now, what I've put here, and that's probably somewhere, let me start there. These dotted red lines, typically I don't have those on my charts when we are talking. And all they represent is we are virtually in the last week of the month. Next week, there's a couple of days, but we're already looking into the last week of the month. And I think with the way I look at the charts, when we are in the last week of the month, we have to start actively looking at the previous week's highs and lows. So you see on all the charts that I've got, the red dotted lines just represent. So when I see this on my 5-minute time frame, I will know, okay, this was last week's support, or this was last week's high, so resistance, last week's low, so support. Because we come into that last week of the month, there's a lot more forces coming in, so longer time frame players start to come into the market. So your weekly traders are coming out, your end of month traders, they're trying to influence that close, the close of the monthly candle. The close of this week is going to be very important, but a couple of days next week and virtually the month is over. Then we're into December and all that December brings. So that's why I've put that there. I'll just show you on one. So you can see on the weekly in terms of the Nikkei 225, that's what I'm talking about. This is last week's candle. High of last week, low of last week. So just, when you drill down to our time frame, then we keep an eye on it. Now, how do we go from a daily time frame to start to look for opportunities on the 5-minute time frame? Remember always, and I've kind of said this a few times, and I think it's important to repeat it, there is always opportunities on the 5-minute time frame to trade any market. So if I used to trade at some stage just the Aussie dollar, and then I traded just the euro. If that's the only market that you trade, the only chart that you trade in, then you just open your charts at the beginning of the day, have a quick look and just go down, and whatever the market presents to you, you trade it. But when you have a lot more markets that you're looking at, as we are presently doing, then you need just to be a little bit more selective in how trades go, from just being on the watch list to where you're going to be looking for trades to take. So in this particular case, when I look at the daily time frame for the Nikkei 225, all I'm seeing is multiple reversals. Okay, so small bodies, tails on top, tails on the bottom. Whenever we have a bull candle, we have a bear candle, we have a bull, bear candle, we have a bull. So there's a trading range that we've been in. So before all of this formed, I looked at it, I said, well, okay, I don't want to be going to look for trading range price action deliberately. I know there'll be multiple reversals, so I didn't put this on my watch list for the day, on my execution list for the day. Things that I want to go in and look to execute is where I'm seeing a setup that I have a 60% chance that out of whatever the setup is, there'll be momentum in the direction that I'm seeing. And I want to go and see if I can jump in early into the market and take an early position. So Nikkei 225 not on our watch list for the day. Now, crude oil, UK oil, crude oil. So, you know, I've put in my green and red high of yesterday, low of yesterday. So this is on my watch list and trying to find opportunities to go long, because the reason for that is this. If you have a look on the most recent price action, the market came down, went up, came down again, went up and came down. So that's a 3-push pattern. That's a wedge that indicates to me that there's an epicenter of forces here that are stopping the bears from breaking to much breaking down to the low end. The red line is the low of yesterday. Okay, again, look to the left. There's another 3-push pattern. First, it's an attempt for the bears trying to go low, failed. Tried again, failed, and for the third time. So again, confluence of forces right here. And a bit extreme to the left, bit of a gap here, which closed. So again, a level of resistance. So from there, my anticipation was that the market would turn here. And yesterday it created a decent enough turn for us. So if you're in the market, there was an opportunity to go along here. Today, because for me, that is not an outside candle. If that had been an outside candle, it converts that whole move into a trading range, but it wasn't. So it was a very strong entry candle off this wedge bottom. You can see the micro wedge bottom and also this resistance level. So presently looking for opportunities to see 60% chance for the bulls at least to go up, maybe to a 50% extension or all the way up, even whether it fails or bounces off there. But you got to find the ways to get in. Now, what happened with that was that somewhere here, what time was it? In here, I took a trade to go long. And I was hoping that the market would just carry on and do stuff. But when I saw this, I just come out of my trade, because this setup for me is indicating that the bulls don't have the momentum that I'm expecting them to have. So break-even trade is just a little bit above break-even. So I came out around here, which is fine. If I do get a decent enough setup arising within here, I'm going to be taking it. Now, what is a decent enough setup? What is forming so far is a trading range, but this is the middle of a potential trading range. So you don't want to be initiating anything in the middle of a trading range, even though there's a level of support there. Okay. If we have a trading range, could this be the low of that? If the market bounces off here, that would be acceptable as a low of a forming trading range. If it goes through here and comes to test here, that is still acceptable. And if it bounces off here, creates a double bottom here or a double bottom here, then of course I want to see acceleration up. I want to see a pullback, and then I can look to jump into the trade. The stop entry has to be somewhere down here. But now I need to see a proper double bottom forming up. I wasn't comfortable to leave that, because that could just accelerate down. Okay, so I'm still bullish, holding on a little bit to that. That's perfectly fine. So that stays there. I mentioned just now on the oil that if a candle becomes an outside candle, I see it as a trading range, and I don't actively just jump into a trading range when there's other opportunities to trade. So trading range, micro double bottom, fantastic, but a trading range has been created with an outside candle. That's a trading range, outside that one, with an inside candle, which would have been a breakout mode candle if it had been closing above its high or closing beneath towards its low. Breakout opportunity, inside, outside, inside. But another doji was created, so trading range, then another outside candle, trading range. So what do you expect to happen most likely? Expecting most likely that today will be trading range price action. So if there were no other opportunities, then you just open up the chart and trade it as a trading range. But I've just marked the high of yesterday, the low of yesterday. Didn't put green and red because I'm not drilling down to look for opportunities. However, if nothing else forms, I can always come back and say, okay, let's look and see. You can take some trading range trades, which will be selling near the top, trying to get out somewhere near the middle, unless there's acceleration. Get into the bottom, looking to initiate longs from the bottom. That's, you buy low, you sell high in the trading range. Again, same kind of thing with the US 500 trading range price action. If you just put up the closes, you can see that it's just going sideways. That's trading range. Tails, 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 bull, bear. So going sideways on that. Absolutely fantastic in terms of what we were talking about before, that there's levels of resistance in this area, and the bears would like their trading range to be prolonged throughout, even to the end of the year, because the longer a trading range is prolonged, the less predictive it is in terms of which way the market's going to go. As it is right now, the odds still favor the bulls. Bulls are saying, okay, pull back. We owned the market. We're still creating a bit of higher lows. So there's still a bit of a chance for them. But until we see strong bull candles, nothing's going to happen. So I don't want to trade trading range price action unless there's nothing else. So just leave highs and lows there. Okay. Then we have the Hong Kong 50. We'll come back to that just now. Let's have a look at euro, and I'll tell you, I'll come back to that. Okay. Now, euro, what we're doing for euro is, you can see high, low. It's on my sell. We're going to try and find ways to jump into the euro and see if we have an opportunity to sell. Reason for that, I think, guys, who kind of tracked this show for a while, you're probably getting bored of hearing, all of these things. But measured moves, breakout from beneath here. Okay, you can see the market carried on all the way down. So there is the height of the measured move. There is the height of the breakout. Now, if the bears are strong, if you're a bear, you say, okay, I'm just going to put my stop up here. I'm going to initiate a sell. How far would I like the market to go? Well, you're anticipating that the market may go to this measured move. Okay, so I know there's a few things here, but what it is this measured move, the height of the bear candles up to there, the extension of that 1-to-1 is here. So that's the level of support where either you're taking profits or you are initiating, you're taking profits or initiating longs if you're not in the market. Okay, but if initiating longs down, it's just for a scalp to the moving average. And I prefer to hold on to trades and swing trades that we carry for quite a bit. Another measured move we have, first leg, pullback, first leg ended here, there's a pullback. Okay, so if you have a first leg, pullback, how far is the market likely to go? Well, the market is likely to go for a measured move, which is also, that extension just here. So there's a cluster of support here. If the bears are strong enough to break beneath this is yesterday's low, they won't follow through to get to that measured move. So euro is on our sell. I'm just going to watch it and see how far we can go with euro. So so what's happened so far? We had a break beneath yesterday's low, pull back into that sideways price action here, which itself was a 2-bar reversal, an attempt to break beneath that. So when you see 2 candles and sideways price action, yes, it's a pullback, but it could also be the last pullback, and there might be one more move and then the market turns. So what you gotta wait for is see if we're gonna get a break beneath this, and then an opportunity for us to jump in and carry on with the market. So that is on our sell. We're waiting to see if we can jump into the trade. We also have gold. Okay, Let's start here. So gold is in an interesting place. I'm going to go to the weekly chart. So there's a channel that's been created by gold, this channel here. Okay, I'm just going to move it up a bit so you can see it. So that channel, that's what I'm talking about. If I anchor it to the bottom here, and I anchor it to last week's low, and you extend it, there is a channel that's forming in here. Okay, so higher highs, higher lows, higher highs, higher lows. So if you're a bull, you kind of looking and saying, hang on, we came away from a micro double bottom. The bears tried to break beneath this, which happened to be the low of the year, and that has failed completely. Bought into it. This is a weekly time frame. And every time the bears have tried to sell, there's been buying, buying, buying. So from a bull perspective, we kind of saying, okay, we're just in a channel. So this is a strong vacuum test, a strong test of that bottom of the channel. And you anticipate that to turn. 60% chance that to turn. And when you come to the daily, yesterday, 2 days ago, that's Monday's candle, huge bear candle. And you kind of say, okay, if the bears are strong, they need to create another huge bear candle and then close beneath this rising channel that we have here. Okay, so I moved it around a bit. Close beneath this rising channel. Okay, test this and just give us an equivalent move. But then we had a bit of tail on top. Bulls tried, failed, tail at the bottom. This red line is yesterday's low. So the question is, the bears are strong. Why did they fail yesterday to close on or near their low? So that we could have an opportunity to jump into the trade. So having that in mind, then the present outlook from a bullish perspective from the bulls is this is going to turn. 60% chance that the market will turn here. And if it does, let's jump into it. If it doesn't, let's wait to see whether we get a micro double bottom. You go down to your 5-minute time frame. So early in the morning, after that move, I think it was about 5 o'clock or so, and seeing a wedge pattern down here, I jumped into the market here, but I put a wide stop right down here. So I'm holding on to a long expectation, 60% possibility of the market going up as far as gold is concerned. But I put a wide stop in here because I know if we don't get the acceleration out of the Asian session, we might get a deeper pullback during the London session, where we presently are in. So I am holding on to that. That's just the high of that's the breakout there and the pullback, so we can take that out. Okay, because that's we've already neutralized that particular magnet. So significant levels at the moment. This is a significant level. So I'm not going to do anything with my trades at the present moment, just going to wait. The reason that there are 2 entries here, because I took it at the market, I just got up and I said, okay, I think it's going to go long, and I've seen the breakout, pull back, and I put a wide stop. I just went 50% risk, buy, buy 0.5%, buy 0.5%. And when I get to take my profit at 1-to-1, I'll close one of them, just hold on to the other. That's why there's 2 entries there. So there's no stop order entry, just bought to the market. Okay, then Hong Kong. Oof, what a cluster! That looks quite messy. Might have to clear some things here to make sense. Okay, on the weekly time frame, you still can't even see that. It's a bit of a mess, guys. But in any case, let's jump onto the 5-minute time frame. Okay, so a 5-minute time frame on Hang Seng, Hong Kong 50. It's quite messy on the daily, but I can still explain the rationale and thinking. I mean, a couple of trades, couple of shorts, which I took up here. So a bit of profit, which is fantastic. So green line, which we can see is a high of yesterday here. Red line, low of yesterday. So that's what I'm trying to show you on the daily, but I've got a few things that's in there, which I will explain to you. The red dotted line, just as I explained earlier on, that shows the low of last week. So that's the level of resistance at the moment. So pretty strong level of resistance. This is my stop loss. So when I took the trades here, when I sold here, I did a measured move. So if you always want to figure out, if you don't know where to put your stop loss, just do a measured move, okay? So I'll explain that. So I'm taking a trade in here somewhere, and I'm not sure where do I actually put my stop loss at that particular moment. You know, the bulls have put 3 push pattern, 1, 2, 3. Now they've put a 3 push pattern. What does that mean? Is that the high of the day, or will we go sideways and maybe the bulls want to attempt to break above this forming trading range? And if they break above that, if I'm still holding on to my thesis that the market is going to go short, where would the bulls want to take the market? So if you break above the trading range, okay. By the way, if you've got any questions, just pop them in. So if you break shapes, okay. All right, so if the bulls break above that, so if you are a bull and you break above that, your goal is to get to a measured move, breakout, pullback. So if you are selling and you don't know where to put your stop, then you must put your stop above there. Okay, so that if you get another double top and a breakout above it, so you get a double top, 1, 2, a breakout above it creates a 3 push pattern, which is pretty strong resistance forces. So if that were to happen, then you don't get stopped out, right? You can still just carry on with your trades. So that's where my trade was. Then when we had this breakout here and pullback, although that was a doji, and I saw that, I figured, okay, strong breakout might be a measured move. So I put an entry beneath that, got triggered into the trade, and the stop for this particular trade, which is the same risk level as I had initially for that, the stop was above here. So put my stop there, then tighten my original stop to that level. So if I get stopped out, the first bunch of trades are virtually risk-free, which is fantastic. So I'm still at the same level of risk. So let's delete that. So that's where the initial stop was. The measured move now is tightened. And then the question is, well, what do we do? Well, you gotta wait and see, right? That's the interesting thing about this. You gotta wait and see if we get acceleration beneath here. I mean, we've been getting tails. So let's see what kind of candle we get. And let's see if bears are strong. Then the bears have got to give us successive candles, some strong candles, right? And if they do that and we get a pullback, right, then we are happy to take a trade after the pullback if we see strength. If we don't see strength, we continue to go sideways or the market comes back to test that high, let's just wait and see if that high actually gets tested. So it's a bit of a waiting game. I'm already in, and if I see an opportunity to build a position, I'm going to do that because it's a little bit messy. But anyway, high of yesterday, a green line on the daily now, low of yesterday. If the bears are strong, they want a measured move, right? To get to a measured move extension, which is down here. right? Which means, I mean, I've taken early trades up there, which is fantastic, but the key level is here. If we break beneath that on the 5 minutes and you haven't taken a trade, then you still have room to take a trade to see if you get to a measured move down here. And if the bears are strong, they obviously want to close the little gap that formed here. Okay, most gaps get closed. It takes time, but they do get closed. So here, this was an inside candle, but bear body, bulls came in, created a little gap, and just bought poor follow through, already indicating problems. But if the bears are strong, if remember, if we are always 100% certain that the market is going to do what we want 60% of the time. So the other 40%, we may be wrong. So I'm talking about bears because of the setup, but it could still reverse, okay, which is fantastic. If it reverses 40% of it, we're still within our strategy. But if the bears are strong, they want to get here and they want to close down here. So potential, we might have a huge bear trend day. So we just kind of leave it there. Okay, this is good for the bears. Okay, bear candle is not an outside candle, so it's not a doji, so that's good. Close the near slow, slide tail. So let's see if there's follow through. We're still not touching our stop. We'll leave our stop where it is until we get, a couple of strong candles close beneath here, small pullback. Then this becomes a legitimate place for the stop. Okay, so that's where we're at. Okay, so probably good thing I got out of my my oil trade. Well, I wouldn't have been stopped out, but my assessment at that stage was that the bulls were not as strong as I anticipated. Excuse me. So the question then, George, is what do you do? I came into the market anticipating that the bulls will dominate the market. I'm not going to change my thinking. My thinking still is 60% probability that the bulls may control the day. So I'm going to leave it like that and wait to see. Just wait for the day to unfold. We still have the World UK session to unfold. We still have the overlap. When the US markets, New York Stock Exchange opens. So I'm still going to hold on to my my little hypothesis that the bulls might control the day on oil. If you look on the daily, this pullback might just be a test of the EMA, but also we still have 50% pullback. So whenever we have a breakout, if you're trading this and you saw this, it was a news breakout in the 5-minute time frame, you don't jump in and initiate. You wait to see, let's get to a 50% pullback if we go back that far and see if the bulls are strong enough. And if you look at yesterday, decent enough to bar reversal. At this stage, if you're looking for longs and you saw the market came all the way down, you don't change your mind and say, oops, now it's short, let me trade short. That's not the way to do it. You got to hold on to your premise, and the market tend, if you had jumped in, you've been rewarded quite well. So, I got out of my trade at break even, just above break even. I didn't lose money on that. So I'm still going to hold on to my premise. Okay, there's the open of the day. There's still the low of the day. This little triangle pattern formed earlier on in the day, breakout pullback. That's what I was quite excited about. So I'm going to wait and see if we get a double bottom in this area. Excellent. But I don't trade the double bottom. I see the pattern, then I want to see how fast we accelerate off that double bottom, see if we close above the moving average and come back and give me a test, then we can look to trade. The market kind of goes sideways a couple of times, a few candles here. All of that, like here, as long as it's within 6 or so candles, I just consider it, the same double bottom. Okay, let's go back to gold. Well, we'll still wait. I'm gonna leave gold in there and see what happens. Euro Okay, euro is going away quite nicely. Gotta now find ways to jump into the market. So we're waiting for a pullback now. Close beneath this level, actually not very pretty. I must just exercise a bit of caution. Okay, we have come, beneath yesterday's low. Bears have broken beneath that, but then we created a tail. We created an inside candle, and the bears just need to just show us some more strength. So let's not jump in here. That's not the pullback that we're looking for. But we keep it on the watch list. I mean, there is still, let's go back to the daily. There's still opportunity to get to the full extension if you look at that whole breakout. So let's not rush into it. If we do get the pullback anywhere in here, our stop initially has to be here. Okay, that's where the stop has to go. You can't put the stop anywhere else. Well, you can put your stop wherever you want. Nothing stops you. But in terms of price action trading, we put our stops at the clearest level of resistance or support. So if you're just looking at, there's a chart in front of me. Where is the level of resistance that I believe the bears are going to defend? Okay, so the best place is to put it here. If you have a very high appetite for risk, then you have to go for a 50% pullback. So you'd simply say, okay, there is initial breakout. I want to jump into the trade. And 50% is just above this breakout point. Okay, so if you were to jump in here before seeing a pullback, you could put your stop there, the 50% pullback. I prefer to put it up here, just allow, the market might come back and test that level. You don't want to be, well, you can be stopped out. If you put your stop there, the psychology behind the trading becomes key. Because if you don't have the, let's call it the mental resilience and fortitude to say, I am putting my stop there. I know it's at the 50% pullback. I know it's at this level. I am hoping that when the market gets here, the bears defend it. Okay, if they don't, and the market tries to test that level and you get stopped out, you gotta be willing to jump back in the market if we get a setup here, double top, lower high. That's because that's the assumption that's right in everything when you put your stop there. Okay, if you're not comfortable in doing that, if you find that you take trades, you put a tight stop, it doesn't go against, if it goes against you and you get stopped out, you hesitate and a few candles go by and the market starts to move, then you jump in because you're afraid to lose again, then don't use a tight stop. Okay, if taking the trade here means you're buying 0.02, then don't do it. Put your stop here at 0.1, 0.01, let it come back, let it do its thing. It's perfectly fine. Okay. All right, so here the bears haven't done enough for us in terms of, giving us the opportunity. So again, we don't want to jump into trades. We leave our stop where our stop is right up there. When we do get acceleration, if we get acceleration beneath here, then we can look to tighten our stop. So we just leave it as it is. Okay, oil, interesting so far. Remember, the bias is still long, right? That's what I'm looking to do. I'm looking for longs here. As I said, my stop was beneath here somewhere, measured move, but that's fine. I'm not jumping into this. And that's just important in terms of how to trade price action. You've got, let's say this closes on up here. So that's a distant enough kind of bull reversal. It's a slightly higher high, double bottom. So it's double bottom with that, but we don't trade that. Okay, that's the pattern that we see. Now we see the pattern. now we have to come and look at the execution. So now we want to need at least 6 candle separation. So, 12:30, we can look at it and see if in that we get a couple of candles come back and give us a bounce here, or if the bulls are strong, they give us a few candles close near the high above the moving average. You come back and look at the execution. So let's say, because this is likely, if it sets up 100% certain 60% of the time, if it sets up and you want to take, you say, hey, George, where am I going to put my stop while you're gone? Here's some thoughts. Okay, so let's assume, or let's put in the law of the day first. I'm just going to put it in for you. I like to draw it in. Too many of these lines. Let's do it somewhere within there. Is the law of the day. Okay, so let's say whatever happens, it goes up, it comes back, and the kind of double bounces doesn't go any lower, right? First place, you can put your stop, just a measured move, because that will be a little trading range that's created there if it's gone up and come back. Okay, high, low. So you put your stop there. Reason we do that is there's a double bottom, market might come back, test that, and the market may still want to test the resolve of the bulls to accelerate, resolve of the bears to accelerate downwards, bulls up, downwards, etc. So market might say, okay, we've tried once, let's try again. Might want to create a 3-push pattern. Okay, 3-push pattern might be the same height as that. So you put your stop here to go long, and then just leave it. Let it do whatever it does. If it accelerates, you get a pullback, you can then tighten your stop. So that's the kind of thinking that you have. I mean, that's worst case, right? If you really want to be conservative, then you just look at, and it's still legitimate. And you say, hang on, the bears who created this might be thinking, okay, leg 1, pullback leg 2. Okay, it's almost, kind of within that zone. Let's put the other one in. Okay, so possible stop levels. One is possible trading range here. If it goes like that and double bounces, you can put it down here or just below there. Either way, you may be thinking, okay, maybe the bears are saying, fantastic, we had that acceleration. We expect a bit of a pullback, but you're going to push it down one more time before we take our profits. When bears take their profits, they're buying back their shorts, then bulls can also come in. So you're saying, okay, I've seen a setup in here. Just in case of that possibility, I can put my stop down here. So they're all safe places. If you get stopped out and it bounces, you just jump straight back into the market. Okay, so that is still on my watch list for long. That is oil. We're just going to wait. Nikkei, I'm doing nothing. So this is exciting. It's taken place, but at the beginning of the day, we had dodges. So, if you came in late, dodgy trading, there's opportunities going to go trading ranges for the day, but there's no point if you can find other setups. Okay, I said for UK 100, the derivative, I think that's correct, of the FTSE 100, trading range price action, inside, outside. So I'm not jumping into trading range price action unless I really have to, and it's the same as the US 500. Again, no need to jump in unless you really have to. Hang Seng 50, we are in shorts and we are waiting. So if you didn't jump in earlier on, fantastic, no problem. We are waiting to see if there's an opportunity for us to get into the trade. If, when we were speaking at this candle, if we'd had a second candle like this candle closing beneath these lows, and then we'd had a pullback like here and a reversal candle like that, that's when you'd be putting your entry in and stop here. We don't have that as yet. Okay, I took that trade much earlier on, so that's helped me to tighten the stop. If we get acceleration, so if you're still watching this, after the show, if you get acceleration, you want to see a close beneath it, you want to see a follow-through candle. When you see a pullback out of that, then you want to trade the pullback and you put your stop up here. Unless you have 2-3 strong candles, you can put your stop above here, etc. Now, just one last thing. What can happen with this? Of course, 40% chance always. Don't ever take that off your mind. The whole thing can reverse. And if it reverses and it takes that out, and I see successive strong bull candles and a pullback, then I'm probably going to say, okay, my earlier trades are in a little bit of profit. My trade here is in a bit of loss somewhere here. I could break even, just get out of the trades. So that's trade management that you have to make, as things are unfolding in front of you. So that's if this whole pattern fails. Okay, how do you exit? You exit when there's a clear reversal. But because we are in shorts, 60% chance we're anticipating there's acceleration. So what could happen in that 60%? If the bears are strong enough to break beneath this trading range, okay, if you're a bear, how far do you want to go? You want to go, of course, to a measured move. Okay, and that becomes very interesting. So if the bears are strong, they want to go to this measured move. And if they get there, then the next magnet they want to get to is that level. So who knows? 60% chance, we're hoping that it gets there. If it doesn't, we just get out on a clear reversal. Where would you get out? Just talk about that. So there's my second entry. My first entry is somewhere up here. Okay, so that's the midpoint of my 2 entries. So if I get strong bull candle, and I can see clearly that the bulls are strong and they break out above this and they pull back and they start to accelerate again. So they can double top or test that once, that's not a problem at all, because it could just be a double top. But if they pull back after the double top and they start to accelerate above it, in that zone, I can get off both my trades and on the sum total not lose any money. But that's not what I'm anticipating. So I'm very happy to just watch things, do whatever they want. No problem with that. But the obvious anticipation is to go down there. Euro, a few minutes left. Okay, so not much, a lot is happening. So reason we don't just jump into trades is we've got to understand and start to see the strength in the market. We have to, instead of just seeing the charts, we've got to see the forces. What forces are driving the market? So yes, we're looking to sell, okay? But every time we've had successive bear candles, sideways price action, 2 bear candles, sideways price action. These bear candles are within the pullback, so it's a trading range. 1 bear candle, inside candle. Why are the bears failing to give us momentum that we are looking for? So right now we have a 3 push pattern, which is a wedge. Wedge is very powerful force, guys. It shows you there's powerful forces that are stopping the market from accelerating downwards. So now I'm thinking, okay, I got to trade what I have, 60% chance that we go in short, but now there's a wedge pattern here. Are the bears going to be strong enough to accelerate beneath it? Because if they do, there will be, likely to be a first leg pullback, second leg, which I can still trade. But if the bulls come back and start to give us successive strong candles, then I'm starting to say, okay, maybe the wedge is going to hold and we're going to have a higher low. And let's see if we can reconsider what's happening in the market. Okay. Gold, we're still going to hold on to that and leave that as it is. We're going to hold on to a Hang Seng 50. We're still looking for longs on oil. All right, guys, that's what we got today. Have fun with price action trading. And please look up the archives if you want to go through anything and ask me questions next time that we chat. Thank you, guys in the office. I appreciate your time and your support. We'll catch up next week.